Hello everybody, here is again our lecture General Introduction to Tax Law, and this chapter is an introduction to value-added tax in Germany, and you can draw the conclusion that probably the value-added tax law in other countries will have similar contents if those countries and only if they are members of the European Union. Good. Here's a short overview. Let's skip that because you are going to experience the contents in the course of time. Let's begin with small introductory facts just to give you a first idea. Well, the value-added tax is the most relevant indirect tax which exists in Germany and in most other states too. It is also the tax with the most individual amount of revenue in the state budget in Germany. And well, that's not so interesting for us, but what we are more interested in is who has to pay it and what is it, which kind of tax. And so the basic information, it has to be paid on the turnover made by enterprises, and the turnover, that's a different word for sales revenues. And basically, it's a tax which is aimed at taxing consumer expenses. In Germany, value-added tax is a so-called shared tax. You have heard about these in the basic chapters. That means the revenue coming from that tax is shared between the federation level and the level of the federation states of Germany, so the Länder. And a small part also goes to the cities. Yeah. You can find all the legal rules for value-added tax in Germany in the so-called Umsatzsteuergesetz, abbreviated USTG. And these rules are officially made by the German Parliament. Naturally, they are German law, so they are made by Bundestag, federal parliament, and have to be agreed upon by the representation of or representatives of the Länder, so of the so-called federal chamber or the Bundesrat. Most of the contents of the German USTG is nevertheless regulated by directives of the European Union, so that most of all contents of the VAT law in Germany is identical to the contents of VAT laws in other parts of the EU, although the texts are different and small differences remain. Nevertheless, important ones, for example, the tax rates can be different. They can still be set freely by the different member states, and some tax exemptions have variations or differences still, and all the tax return stuff, and so all the administrative things are also still different. By the way, in the long run, the European Commission dreams of a value-added tax law which is so strongly harmonized that you can, that's their idea, hand in your value-added tax declaration with effect for all the member states in your home state. They collect the money and pass it on to the other states, but that is at the moment still a castle in the air, so that's something which they hope for the future. Only first small steps have been made into that direction. Well, the most basic facts in German USTG is naturally the rates. At present, 19% on all goods and services, and a reduced rate on things which are taxed at a lower level just because they are very often parts of the basic needs of life. Yeah. And perhaps you know that there has been a temporary reduction for half a year of the rates in Germany, but that is just going to be over in 2 days, and so we don't need to memorize that. That's nothing which is of principal interest for us. Yeah, what's more interesting is to think about what follows from the fact that value-added tax is an indirect tax. Remember first, what is an indirect tax? A tax which is levied indirectly. And that means indirectly taxing somebody, you want to hit with the financial burden some person, but officially you tax somebody else with the plan that that somebody else is going to pass on the financial burden to your real target. So the idea is an indirect tax is a tax where the person who is officially obliged to pay the tax is different from the person who in the final end is meant to end up with the financial burden. So the legislator already plans that the official taxpayer is going to shift on the tax, for example, via the price mechanism to somebody else, for example, to customers. Good. And if we analyze that a bit more closely, then that works this way. For example, imagine you have the plan to levy a coffee tax, a tax on coffee, which is meant to be €2 per kilogram coffee. Then a business owner would calculate the costs of acquisition of my coffee are €1. I need a profit margin of 20 cents, so my desired net price, which I want to obtain from my customer, is 120. Now the coffee tax is also something which I have to cover because I have to pay it. So I add the €2 of the coffee tax to my price, and so my final gross price, including the tax, will be €3.20. The same idea underlies every other indirect tax. You just know as supplier you will be forced to pay a tax, and you add it as a part of your cost to the price. So the underlying idea is usually it's difficult to tax the consume of consumers because they don't have a bookkeeping. You can't control them. Then they are so many. So you would have to look through thousands or millions of tax declarations. That's not convenient. And now a basic equation is that the expense of the consumers is identical with the revenue of the entrepreneurs. So that makes it easier to focus on taxing the revenue. That makes it far easier to check what's happening because the entrepreneurs have a bookkeeping. You can check it. You have far less tax declarations to deal with than if you deal with all the consumers. And so that's the reason why taxes are designed as indirect taxes. Now, let's go to some basic principles if you want to levy an indirect tax. You will have to obey with your legislation to certain principles. The most important and fundamental one, from which probably all the others derive or can be derived, is the principle that the tax must be neutral for competition. That means that competitors who are equally good before the tax comes into play must remain equally good after the tax comes into play. So why is that necessary? And the answer is, let's look. If you want to understand the rule, just imagine it were different. What would happen? Then you see probably the sense of the rule. Now, so imagine that not everybody is taxed with the same amount of euros per kilogram coffee, but differently. So let's violate the principle that all people should be taxed in the same way so that the tax is neutral and fair. Well, then we would have the following price calculation. Trader A would have cost of acquisition of €1. Trader B would have the same. Profit margin desired by both shall be also equal 20 cents. Now, coffee tax shall be for A €3, €2, for B €4. So their necessary price demands would be for A €3.20, for B €5.20. Now there is one question: which of the two will survive into next year? And you can see the answer already from the red lines here. Trader B is doomed to die out, to leave the market, to go bankrupt, because nobody will buy from Trader B. If all the other circumstances are equal, then it's clear that only Trader A will survive. And that is a reason why traders, suppliers should be taxed equally. Otherwise, you don't achieve more money. Demanding €4 from a category of traders would be entirely senseless, because you just doom them to die out. So in the long run, you will never get that money. Only trader category A will survive, the ones who pay €2. So you can directly obey to that principle in advance and say, okay, I take you €2 from everybody or €4 from everybody. Taxes burdens must be equal, otherwise you distort competition and just remove some of your people from the market, and that should not be the aim of a tax law. If you deviate from the principle, after a while, only the best category of suppliers will survive, so only the category which is taxed in the best way, and so you end up with neutrality again. The price which you pay for the deviation is only that you remove some jobs and kill off some businesses. In the long run, the system can't work without neutrality. Now, how can you design an indirect tax in a way that it is neutral? There are different approaches which are possible. First, you take the same amount of tax per unit of the product. So as in my first primitive example, €2 per kilogram coffee. This approach is subject to some conditions. You must define the product, you must be able to measure it, and so on. So that's not probably, that can't be easily done with some kind of product. With others, you can do it. So it very much depends on what you are going to tax. You can make a second approach. You just add a certain percentage of the price which somebody wants to claim. Then also you have equal chances, because if somebody is going to demand a net price of €2 and somebody else is going to demand €2 net price too, after adding an equal percentage to both of the net prices, the two have again equal gross prices, so no distortion. And if you have one who is not so good as the other competitor, for example, the one asks €10, competitor only asks €5, so that there is a difference in the price of 50%, then after adding 19 or 20% of the prices, then the difference will still be 50% of the price. So the sequence or the ranking of the competitors will not be changed by that approach. Or number three would be you could combine the two approaches. For example, I believe that the case was tobacco case. Don't nail me down on it. It's probably, I'm no expert in tobacco cases and similar things, but there are some taxes where you pay a fixed amount per unit of the product plus a certain percentage of the price which you demand for it. Also, that would be neutral. That is that's regularly comes out. By the way, naturally, you should be familiar with the basic terminology here. So when we talk about a gross price, it's always the price which includes the amount of the indirect tax. And the net price is the price before the tax is added. So here below you see the relationship. Net price plus 19% is gross price. So net price would be 100%, 19% VAT comes on top. Gross price would be then 119% of the net price. That's an easy relationship which you can remember, I think, and I hope so, easily. Now, I hope we have understood now why taxes must be neutral for competition when they are indirect. Now let's draw first consequences from that general principle. What does it mean for external relations? Well, let's imagine what would happen if every supplier paid his or her tax only at home, where he or she runs the business. Then imagine you have two countries, country A, country B. VAT rates are 10%, 20%, naturally, just to make things easy. In between, we have a nice border. And here in country B, living there happily is a customer. Now, imagine the two suppliers have equal conditions. So supplier A has production costs, including his profit margin necessary for survival or profit margin desired. They end up with a net price of 100. Supplier B, the same, needs 100 net. Now, supplier B would calculate the price in a way as the VAT rate in country B demands it, adds 20% on the net price, ends up with a gross price of 120. That's it. The price for which he offers to the customer is 120. Now, imagine supplier A just is treated under the law of country A. Then we have a price of 100 plus VAT rate of country A, which means 10 euro only. Then supplier A could offer one for 110. Now you could ask yourself the final question: where will the customer buy? And the answer is customer knows the difference between 110 and 120, so customer will order from supplier A. And the question which pops up here is easily to be answered. Which supplier will be still alive next year? And the answer is only supplier A. Now imagine what that means if you have these two countries. Well, you don't kill off only supplier B, but you would kill everybody in the market of country B, because all existing businesses in country B would be outcompeted, undercut, just due to the VAT rates by their competitors from country A. So country A would flourish and country B would lose all its enterprises. That cannot be the aim of a VAT system. No state can ever afford to let in foreign products for a lower VAT tax burden. That's the logical conclusion. And now the technical question is, how can we achieve that? You can't negotiate with 200 countries in the world that they all take care that their VAT rate is not lower than yours. So there is only one possible consequence. You must make sure that everything coming from outside to your country will be charged with at least your VAT rate, and the simple way is how you can achieve that. Everything which comes from the outside of the world to your country will be taxed under your own VAT law. So everything which is imported into your country is just simply taxed at the border with your VAT rate on its market value. And then you automatically have secured that no good coming from outside world will ever be lower taxed than your own products. Let's see how that works. Country A again has VAT rate 10%. B has again a price of 120. Now supplier A tries to make an offer. Net desired price would be 100. And now the inland tax comes on top with 20. So we have a minimum of 120. Supplier A can, if the costs are comparable, if the two are equally good in their economic behavior and have comparable costs, then supplier A cannot undercut the competitors in B, and so we have neutrality of competition secured. So first basic principle when it comes to external relations is all imports will always be taxed by a country where they go to. No country can ever afford to renounce on that, otherwise you would ruin your own sector of industry or trade in that area. Good. You can't underestimate the drastic consequences which would happen if one could avoid such an importation tax. If any small good or so can enter the country without being taxed at the border, that potentially leads to the breakdown of your complete market in that sector. So you must absolutely make sure that foreign goods cannot come into the inland untaxed. The only exceptions which you could make are those where it really plays no role. So if somebody comes with a chewing gum and crosses the border, it's probably too bureaucratic, too expensive to tax the single chewing gum. So the amount of tax would be too small, and the costs of the tax declaration procedure would be so high that this would be self-destruction of the state, and the one single chewing gum would be harmless for competition because it's just a rare and unimportant occasion or event. But you would probably have to draw the line for simplifications relatively lowly. It depends on how dangerous untaxed imports can become for the inland economy. So principle is, nevertheless, everything which comes from the outside world will be taxed. Let's go back again, see it again. One of the examples which people never realize is, for example, if a spaceship would come with aliens on board and would land in the middle of Berlin or at any other place of the world, what people always forget is not only police and army would go to the spot, but also the customs duties officers, because a huge and valuable object has come from outer space into the inland, and that must be taxed because it crossed the border. Full stop, over and out. And by the way, if you tell that extreme and a bit joking example to somebody working for the customs office, they will not see where there is a joke in that. So anything crossing the border must be taxed. Exemptions will be very, very restricted. Okay. Yeah, on the other hand, exactly that insight that every import will be taxed in the country where it goes to leads to logical consequences. Countries from which things are exported must leave their exports tax-free because otherwise they would end up being too expensive. Why? Look again at our little sketch with the border, the customer in country A and country B, and countries A and B. Imagine now supplier A, production costs 100 again, supplier B, production costs 100. Now, supplier B calculates just simply 20% on top, 120 necessary gross price. He can offer for 120. Supplier A has a net price desired of 100, has in the country where the good goes to pay 20. If now the inland tax also comes on top, then we have a price of 110 at the border plus 20, or better, it would now be probably 22 because the net price at the border is 110 now. But don't quarrel or dispute about that. We would have now a minimum price of 130 or 132 for the foreign product, and that would simply exclude all suppliers from country A from the market in B. They are too expensive. 2 times VAT on one single product. That's 1 time VAT, once VAT, too much. That kicks you out of the market. The disadvantage in the price is so high that you will be excluded from the market. So if you don't exempt exports from indirect taxation, then you will have no exports. That's the plain and simple truth and consequence. So we have 2 simple conclusions already which we can draw. All imports must be taxed and all exports must never be taxed. And if you sum up the basic idea of that, then you can simplify that by saying one thing. An indirect tax on goods or services must only be levied in the country where the good goes to. So in the country of destination, where the customer gets them, uses them, not in any other country. Well, if imports are taxed and exports are tax exempt, that directly leads to an additional consequence, which is very often overlooked. For example, by nice people who end up as British prime ministers and call themselves Boris Johnson also. You need border controls. Why? Well, the first thing is simple. Why are they necessary? Because if you don't have a check at the border, then goods can cross the border unnoticed. And now I don't know what you would do if you need to pay a tax at the border, but nobody checks if you really do so. There are 2 alternatives. You might be honest, then you nevertheless pay the tax, or you might fall victim to something which is called temptation. I just crossed the border with, let's say, 50 kilogram coffee. That would cost me 100 euro coffee tax, but nobody saw me. Okay. Smuggling, ladies and gentlemen, that's called smuggling. So if you have a way to bring goods into the country untaxed, and that is not detected, then you will do it. Or if you don't do it, then others will do it. So the legal market, the market of all the goods which are really taxed, will suffer, even might in the end break down completely. Must be avoided definitively. Market would break down under the competition of untaxed goods from abroad. And the second idea is, why are border controls necessary for the exports? That's a bit more difficult to grasp. But I give you a hint. Exports are tax-free. Now I'm a business owner, and I don't like to pay 20% on all my revenue. Now I can't hide that I really produced 1,000 machines, and as they are all gone away, I have evidently sold them. That's difficult to hide, but I want at least not to pay value-added tax. So there is one simple story which I can tell to the fiscal office. Well, 900 of them were all exported. Here, let's go to my archive. I have all the addresses of the foreign customers who ordered the machines. Well, all these letters are faked. There are 2 people working in the cellar of my enterprise in a small hidden office room and faking orders. Every time when somebody from Berlin, from Munich orders a machine, They get them delivered. Afterwards, we burn the whole correspondence and fake a new one, which proves that the machine goes to Russia. And then we don't pay value-added tax. Oh, that's so easy. What do you think? Would people do it? And the answer is, they would do it. Naturally. Temptation is far too high. Now you would say, oh, but there must be honest people too. And the answer is yes. The honest people only give in to the temptation after 3 months, but then they also fall victim to it. So you need experts. You need border controls for the experts. You need an attestation that this specific good really crossed the border and can never come back unnoticed, so that it left our market and can do no harm. So you must really ask them, the suppliers, the sellers of goods, if you claim an export exemption, you must prove that the good really crossed the border, left the country, and cannot come back unnoticed. Okay. Because otherwise people would just sell things in the inland without paying the tax to inland consumers and would pretend all these things have been exports. And so you would have, again, honest business people paying the VAT and going bankrupt in the long run, and the dishonest ones who just pretend they exported things. So border controls are vital for the functioning of any indirect tax system. Logical consequence, tax exemption for exports must be, but you must strictly be bound to give proofs that the good really left the country. Otherwise, you can directly close down all your economy and pack a rucksack and leave your country and spend the rest of your life somewhere poor in the desert of the Sahara also, or travel around the world as a backpacker and enjoying life, because you will never ever have a functioning economy in your territory anymore. So you could directly leave. Why stay somewhere where a country is doomed to be ruined? Good. Yeah, so we have already some rules for external relations. The basic principle is taxation in the country of destination. Now, a further consequence for neutrality, or from the neutrality of for competition principle, you must also treat the chain of entrepreneurs in a neutral way. A long chain of supply and a small chain of supply, or one doing all the steps of production on his own, all these people must be treated equally. And again, the question is why? And again, we can understand that in the best way if we just imagine the principle didn't exist. So let's just imagine we have 3 suppliers, and now we just tax every sale of a good with value-added tax just as it happens. So supplier A is meant to have costs of 100 for material and labor. By the way, we just assume that for every step of production here for supplier B and C equally. That's just a simplification or an assumption. With other figures, it also works the same way. So costs for raw material and labor, step 2, 100. Third step of production, 100. Now supplier A, who just does the first parts of producing something, let's say transforming raw material into steel or so, calculates the price which he needs as follows. Cost is 100, including profit margin, but I left that away for simplification, plus VAT 20%, because 20% is far more easy to calculate than 19%, and this is a theoretical example, so What's about it? So let's take 20%. Then we have a price which is necessary to survive of 120. Now, supplier B has own costs of 100 and needs to buy raw material from supplier A because he's going to transform that steel into something else, let's say a car or so. Then the calculation for the price will be cost for the raw material bought from A is 120, own cost is 100, subtotal, or the net price needed is 220, VAT 20% on top is 44, final price claim must be 264, otherwise enterprise of supplier B can't survive, can't cover his costs. Supplier C buys raw material from B. Now the calculation is raw material costs 264. Own costs come on top 100. So the net price must be 364 if we don't want to make a loss. 20% come on top, that would be 72.80, and supplier C so has to demand a price of 436.80 euro. This is the final price with which this supply chain will have to ask. Now, the alternative, one supplier does everything alone. I call that the Scrooge McDuck approach. For the German and only German-speaking people, Scrooge McDuck in Germany, that's a Dagobert duck. And that is the richest man in the world in the Donald and Duckburg world. So Mickey Mouse and Donald Duck. And the old Scrooge McDuck does everything. He owns factories, mines, coal mines, everything. Can do everything on his own. So no sale will ever take place in between. One person does everything from the beginning to the end. So all the 3 steps of production are done by Scrooge McDuck himself. So 300 euro are the costs which need to be covered. So that's the necessary net price. 60 come on top, value added tax, needed price is 360. So yeah, our friend Scrooge McDuck can offer the same product as the suppliers A, B, C for a price of 360. And naturally, there is one question which shows up. Where will the consumer buy? For 436.80 or for 360, and the answer is clear. They will all buy from Scrooge McDuck. The small enterprises A, B, C will die out, and that leads us to a conclusion. A state which does not guarantee neutrality for the chain of entrepreneurs. So for the supply chain, it does simply exclude all small enterprises from the market and creates monopolists or huge, massive enterprises, trusts or so, like the Scrooge McDuck empire. This is really not what a state should do. So if you want to have a market economy, that's exactly the wrong way. So you need to treat all the entrepreneurs in a way that they have equal chances, irrespective of whether they share the work distributed among several enterprises or if one does everything. That can easily be proven that even the monopolist or the one does all would be preferred due to the tax effects if that person worked less effectively. Imagine again our 3 different suppliers ABC can perform their steps of production for cost of 100 each. Then you have to end up with a price of 436.80 as I showed you some slides ago. And now let's vary the situation of the Scrooge McDuck empire. Imagine they waste money and Scrooge McDuck can only perform all the steps of production for 110. In that case, the total net cost would be 330. 66 would come on top for the VAT, and the price would still be more favorable than in case of A, B, and C, although A, B, and C work more effectively. So such a system would also support the waste of resources by your economy. So everything would be extremely bad. So you must design your VAT system or any other system of an indirect tax in a way that there will be no distortions in connection with the length of the chain of entrepreneurs which are involved. How can you do that? First idea is just restrict your tax to the final sale to the computer or to the consumer. Just only levy a VAT on the sale to the final consumer. Now you see here that does not work for practical reasons. Why? Now imagine you are a shop owner. Customer drops in and wants to buy paper. Then you say, okay, let's have a small conversation. Are you going to buy that paper for business purposes? Then you get it for a net price, because then you are a business customer and not a consumer. Or do you buy that paper for private purposes? And customer says, don't know. What do you mean? What would be the consequences? You say, if you come here as a consumer, the price is €1.20. If you buy it as a business customer, you get it for a net price of €1. Okay. Now, what would you answer? Naturally, you say, I'm a business owner. Now, the fiscal administration would probably force then the shop owner to be not so naive to believe all the customers. So seller would have to check if your statement is true. And then the next thing happens. How can you check if your customer tells you the truth? How are you going to do it? Torture? Are you going to search the house of your consumer if that consumer or customer really has a business? What would you do if your customer says, well, I'm going to use half of the papers? It's a package of 500 sheets of paper. I'm going to use approximately half of them for business and approximately half of them for private purposes. How do you now type in that situation into your computerized cash register? Absolutely impossible. So forget about a tax which is only levied on the retail stage of the sales process. Well, you could also say we only collect the tax when a good is first produced, but that's not easily possible, because you can only do that, let's say, with an exactly defined product, because otherwise, because you need to be able to define when the product is first finished. Well, so you could debate about taxation of cigarettes or so. Well, there such an approach could be used, but not when it comes to all goods and services. So what VAT is aimed at. The solution of the VAT system is therefore simple. First, they decided to levy the tax on every level, always. Every business owner who sells something or renders a service has to add VAT to the price. Now then we have that ABC situation, so that the tax amount would accumulate over time. How can we then avoid that? And the answer is simple. The business owner can't check who the customer is and what the customer does with the acquired things. But the fiscal office can do. The fiscal office can make an inspection, review the customer's bookkeeping, and find out if that customer really is a business owner, if that customer really used the paper for business purposes or for private purposes, and so on. And so that's exactly the idea. The business owner always charges VAT on the price. And if the customer is a business customer, the fiscal office gives back the VAT in the price to that business customer, so that between business 1 and business 2, or between supplier A and B, the VAT cost effect is removed by the refunding of the VAT. And now the fiscal office can go and check if that really was the truth, if B really used it for business. They have the power and the capacity to check it. And if he lied to them, that would also be tax fraud, and then you would be punished under criminal law. So that could work. So how does that change the economic situation? Imagine now supplier A, B, C again. Raw material always 100. Now A sells for 120 because net price needed is 120, come on top, 120 is the needed price. Supplier B buys for 120. Now that price contains a VAT amount, and so he gets for that 120 a refund from the fiscal office of minus 20. That lowers his cost to 120 minus 20, so to 100 for the purchase. Own cost of 200 come on top. Minimum price to be claimed is 200. VAT 40 comes on top, 240 is the possible price for which B can sell to C. C now makes his own calculation. I bought raw material from supplier B for a price of 240. Minus 40, the VAT included in that price, will be refunded by the fiscal office. So my net cost for the raw material is only 200, plus my own cost of 100 for labor and so on. Subtotal, my necessary net price, which I need to calculate, is 300. I add the VAT of 20% on top. We end up with 360. And this is now exactly the price which Scrooge McDuck would have claimed. And so you see here how the cost effect of the VAT is always eliminated from the calculation via the refund mechanism. Oh, that's called input tax deduction. Yeah. How that cost effect of the VAT during the production process is eliminated again and again and again, and only the final customer, the consumer, only that person cannot claim a refund, because that person is not somebody using the goods and services bought for production purposes. Consumers are not business owners. And so only the final contract between the supplier C and the final consumer, there the VAT will become definitive. In all other cases, it's just a temporary levy, and the fiscal authorities even take great care that to avoid liquidity costs, the refund is made nearly at the same time as the payment to the fiscal office is made. So the idea is VAT in the same chain of entrepreneurs should really become neutral and removed from the cost. So we have a kind of a ping pong game. 20 go to the fiscal office from A, then B gets them refunded, and when B then sells to C, B pays 40. Now supplier C claims the refund, and when C then pays to the final consumer, C pays 60 on his own output, and that's it, because that was the sale to the final consumer. This mechanism also explains why value-added tax is called value-added tax, because naturally the refund claims and the output tax payments are declared in the same tax declaration, just to simplify matters. And so supplier 1 pays 20 at the end of the month. Supplier 2 says, I owe you 40 and I get a refund of 20, so I pay 20, only the difference, to the fiscal office. Supplier 3 calculates his payments, which are due in the same way. I owe you 60, you owe me 40 as a refund, so I give you 20. You can even represent the same calculation in a slightly different way. Supplier 1 pays 20% on 100. Supplier 2 pays 20% on the difference between 200 minus 100, the costs of the goods which were acquired from others. Supplier 3 pays 20% on the difference between 200 and the goods bought from others, 200. And this difference between 300 and 200 or 200 and 100 is just the value added in the production process to the original product just by doing additional labor on it. And that explains why the tax ended up with the name value added tax. Because when you look to these differences here, every supplier only pays effectively an amount on what he added to the value of the previous goods or services. That explains, instead of turnover tax, why there is also an official denomination of the tax as value added tax. Although it's in reality and technically a tax on the total turnover, the revenue from sales of an enterprise. Now we end up with some bureaucratic necessities. If every supplier can claim input tax refund, then you must be able to check if these purchases have really taken place and if really the prices contain VAT. So you must be able to check these transactions. So you need confirmations from the previous suppliers that they really charged VAT and paid it over to the fiscal office. For this, you need an invoice which shows the net price plus the VAT. So you need to check that. And just to repeat that, you also have to check exports and imports. Now, that explains why VAT, although between enterprises it has no real financial impact or cost impact, can become highly dangerous, because if an invoice confirming input VAT has a formal mistake so that the fiscal administration regards it as not sufficient to guarantee that the VAT treatment by the former supplier was correct, then the claim for input VAT is lost for supplier B, let's say. And so that means a slight mistake in an invoice. For example, you forgot the date, or you messed up the series number of the invoice, or you forgot another required necessary detail on a VAT confirming invoice, then the input tax claim is lost. And so making slight mistakes in VAT matters leads to enormous drastic losses for the businesses involved. The same, by the way, happens also with documents proving exportation. If there is the slightest doubts that the document are complete, or if there is the slightest doubt that something could perhaps not really been exported, then the tax becomes due. So if your proofs have some flaws, 20% or better German tax rate, 90% of your revenue are gone. No? Imported goods have been overlooked. Also there is a risk. But for the enterprises, the two risks, the first two, are the major ones. Entirely dangerous. That is why you must be absolutely familiar with value-added tax rules in real life. Yeah, as I already told you, the legal background is simple. We have in Germany legislation by Bundestag and Bundesrat together, so by the German Federal Parliament. They must approve any law in VAT, any changes therein, but these changes are usually dictated with a percentage of, let's say, 90%, although one cannot really measure percentages of changes in laws, so that's just a felt number, something which we feel. You have to follow orders of the EU on that. So you can be relatively sure that, let's say, 90 or 95% of the contents, again, one can't really measure that, of the VAT laws in a member state of the EU will have the identical contents. So in principle, VAT law is mostly regulated on the EU level, and the member states just have to follow EU orders on that. We have different legal sources. Therefore, in Germany, we have the Umsatzsteuergesetz, USDG, or translated VAT Act. In other states, it would be called the VAT Act. In the UK. Okay, that has been turned into history, although VAT law in the UK still exists even after they left the European Union, because their VAT Act is a national act and will only change when they change their VAT law for the first time and then differ from or deviate from the rules of the EU. Until then, still the same things. And we have, apart from the domestic law, also the EU directive on the common system of value-added tax, which has approximately 410 articles. So many details have been regulated already. Because now all the national laws, or most of the national laws, go back to orders in the EU directive on VAT in questions of doubt how the law has to be interpreted correctly. When you interpret a law, you have to ask what the legislator wanted to say. And here now, from the legal background, there's one simple, plain thing known. The aim of the legislator was to slavishly follow the orders of the EU on the matter. And so, if you want to find out, in cases where there is a doubt about the interpretation, what Parliament really wanted to write down and really wanted to say, they wanted to follow the EU orders. And if these EU orders in the directive are not perfectly clear, then you ask the European Union Court, the European Court of Justice in Luxembourg, for a binding interpretation of what the EU directive means and says on that matter. When you once know it, that was what our national parliament wanted to say when they wrote down the law, and so you know how to understand your own national law correctly. So very, very often you have decisions of the European Union Court, European Court of Justice, which decide what the EU directive on VAT orders, and then you know how your national law has to be understood. Very often politicians do not know this background, or they do not see to accept the necessity. And at present, one still has to hand in, if you sell to other countries, different tax declarations in 27, please excuse me, this slide is still from former times, 27 member states, 27 different tax offices, and in many, many different languages, not 28 but 24, because the European Union has only 24 different official languages, but that's really terror. And now imagine that were not harmonized completely or nearly completely so that all these laws had similar contents, then a Spanish tax advisor would not only have to fill out your Spanish tax declaration, but they also would have to give you a basic introduction course on Spanish VAT law so that you could understand how the Spanish tax base could be calculated in deviation from the German one. And so you would probably never be willing to offer something to a customer in Spain. You know, if you deliver something to a foreign market, the general aim of the legal system is it should be paid, the tax should be paid in the country of destination. And that would be awkward if you then have to apply Spanish law, and if it were so different from your own home country's law that you would have to understand a completely different legal system. So you need to have a harmonization. And by the way, as I already mentioned, the EU wants to establish in the long run a common system, a kind of a one-stop shop approach, that you stop at one shop, one tax office, and hand therein your tax declaration for all the EU member states at once. At the moment, this has only been tested in the internet sector. That is therefore called the mini one-stop shop approach. Good. If you are interested in the historical development, it began relatively simply with the first directive on value-added tax, which just established the VAT input refund system as the common system for all VAT laws in the Union. 1977, there was a sixth directive on VAT, which said we harmonize also the rules to calculate the tax base, and later more and more details had to be added. And so the sixth directive was always changed and enlarged. And after it ended up with, in a very, very complex status, a recast was made. So a new version of the existing law was drafted with no change of the real contents. That was the VAT directive, or directive on the VAT system from 2006. And then we had 410 articles, and some minor questions are treated in additional laws like VAT regulations of the EU or of the Federal Ministry. Now, that all doesn't help us when it comes to solving cases. You know that if value-added tax things are treated in the wrong way, there are drastic consequences. For example, charging a wrong amount of VAT might have the consequence that the customer cannot deduct the wrong VAT as input tax. So it's extremely important that everybody can easily check the VAT situation without making problematic wrong decisions. And so we have an official testing scheme for cases, which is always binding. And the first question, which is a kind of introductory question, is always, is it taxable? Is a transaction or an event taxable? That means, is it potentially possible that inland VAT could be charged at all? So does the tax come into consideration at all? For example, you cross a road on foot as a pedestrian. Can that trigger VAT? And the answer could be found in step number 1. Can crossing a road be a taxable event? And the answer is a strict no. Falling down from a tree, is it a taxable event? And the answer is no. That's no potential VAT event, so you can stop any testing there. If it comes out it could be a VAT event, then you have to check afterwards, is there an exemption from VAT or is it liable to tax? The basic rule there is, if something is taxable, it will always be charged with VAT. It will be liable to tax, apart from the cases which are declared explicitly as tax exempt. Now, when after this step you know that VAT is due, you need to calculate it. So you need a tax base. and a tax rate later. But now a tax exemption in the field of VAT is not always a positive thing, because there is a basic rule which says in most cases where you have a tax exempt output transaction, so when your good or service is tax free which you render to others, then you can also claim no input tax refund. And that might be devastating. Imagine you have erected a factory building and paid 20 million plus 4 million VAT, and you could recover it as input tax. But now the products which you produced this year in December only were, let's say, tax-free. Then you can't recover your input tax, and your input tax would be far higher than the output tax, so you lose money. For this specific situation, sometimes, and that is important, only sometimes, in 3 or 4 occasions only, it is allowed to opt out of a tax exemption and into tax liability for some events. But that is rather rarely the case. But it explains itself from the idea that in these rare events, even the legislator saw we should give those people a chance to recover or to keep their input tax deduction, but then they should also pay the price that they should be willing to pay the output tax. By the way, very often having to pay the output tax does no harm, because it might be that if you have a business customer, for that business customer, it makes no difference if you charged him or her 10 million net price tax-free or 10 million net price plus 4 million VAT. If your customer can recover the 4 million VAT as input VAT, then for him it does play no role. He will always accept the gross price. And so opting for tax liability where it is allowed can be positive for you in such a constellation. Then tax rate and tax amount have to be determined and calculated. Naturally, in a case solution, everybody wants that you also calculate the amount of the tax and not only say if it's 19 or 7%, clear. Then the next questions are minor formal issues. For example, the taxpayer, who has to pay the tax? Mostly it is the business owner. Sometimes by way of exception, it is a customer, if that is more simple to both the fiscal administration and the customer or the parties involved, but that must be regulated strictly in the law who is taxpayer and who is not, because it must be determined where the fiscal office can confiscate the money if somebody does not pay in time. The arisal of the tax is just nothing else than determining the time when the tax burden begins to exist. Usually after a tax has become existent, you need to pay it and can't avoid that anymore. Invoice requirements, pay declaration duties. My personal thumb rule to memorize this is paid, P-A-E-D, payer, arisal, invoice, declaration. Well, sometimes you are not fully through with the case. It might be that some special aspects show up, which the testing scheme up to now could not cover. That could, for example, be that the business owner wrote the invoice in the wrong way. That is something which you can only comment and find out if you know already how the invoice should have been written. So not possible after stage number 4 or phase number 4 of our testing scheme has been completed. Perhaps you have charged or confirmed more VAT in the invoice that you really owe to the fiscal office, or other things like that. All that can only be commented here, and you can then find out what the consequences are. And last but not least step is input tax questions. So Are there any input tax claims or consequences for input tax which result from the events which you have analyzed up to now? Input tax claims for the seller, for the buyer, consequences now, consequences later. Are there any things in the case which comment this? Let's begin to talk about the first step, taxable transactions according to the USDG, according to VAT law. Deliveries of goods and services in the inland by an entrepreneur who acts as entrepreneur and not as private person for consideration, so for getting something in return. As this is a simplified introduction, we will leave out in the further discussion in entrepreneur acting within the entrepreneurial activities range and for consideration, because that's usually plain and simple. You will probably be confronted with that in later parts of your study program. Number 4 is taxable transaction is the importation of goods from a third country into the inland, or better, in the inland, because it might be that a good crosses the border in Spain, and with the permission of the customs duties authorities, it might be possible that the importation is, under the legal aspect, only effectuated in the country of destination, for example, in Munich or in Mainz or in Cologne, so that the importation legally takes place there instead of at the Spanish border or so. Number 5 is intra-community acquisition of goods by entrepreneurs in the inland. That's a kind of a parallel rule which covers some importations of goods which come from the rest of the EU into the inland. And as you see, numbers 2 and 3 are missing in the list. That just goes back to the fact that numbers 2 and 3 have become superfluous some decades ago because jurisdiction and legislation just included number 1 or the former numbers 2 and 3 into the present day number 1, so that number 2 and 3 became superfluous. Let's analyze the most important taxability rule. Nearly 90% of all things are covered by it, if not more. That's number 1, the delivery of a good in the inland. The conditions when we can speak of this are laid down in section 3.1 of the USDG, and we can perhaps have a short look on that section in order to have a glance at the Tax Act. Okay, so let's have a small look to the Tax Act slides with translations, unofficial ones, which I made for you for exams. And here is the table of contents, and let's jump to value-added tax, if it works. There we have them. And we need section 3.1. And as you see, I only translated and did not translate the whole legal sources always. I only selected the ones which one probably needs to work. And that is why you don't find everything there. 3.1 USDG can be translated as deliveries and services. 3.1 first sentence, deliveries of a good by an entrepreneur are activities by which he or somebody else in his name enables his customer or somebody else acting on behalf of that customer to dispose about a good or of a good in his own name. So you could call that transfer of economic ownership or transfer of control. So that brings us to the following overview about our delivery rule. The delivery is the transfer of the position like an owner, and it must concern a good that is a tangible asset. Tangible is something which can be touched, in contrast to a right, an idea, or something like this. Now, the next question which we have to ask ourselves is if the delivery happened in the inland or not. If a delivery takes place in the inland, has to be determined strictly and only under the legal rules of the USDG. And by the way, these rules are harmonized within the EU, because if something has to be taxed in the inland or in the territory of another EU state, that has to be regulated in an identical way everywhere, because otherwise you would have two countries ending up with claiming the VAT on the same transaction, and that would be ruin of the people involved. Then you would have a double taxation in the field of VAT. That must be always strictly avoided, and that can't be, so you have identical rules throughout the EU. The rules for the determination of the place of supply of a delivery or place of delivery can be found in paragraph 3, section 6 USDG in the German rules. So in case of a delivery which is connected with the movement of the good in question, so if somebody transports the good in connection with the delivery, if the good is brought from the supplier to where the buyer needs it, then the place of delivery is always to be assumed where the movement of that good towards the customer begins, not where it ends. And 3.7 means in case of a delivery where there is no such movement, there the good in question, the delivery in question will be made at the place where the good is at the moment when ownership, or better, the position like an owner, is transferred to the customer. Yeah, here is again the translation from the Tax Act slides. If a good which is delivered is dispatched, so moved, by the supplier, the customer, or somebody else who acts on behalf of one of those two, the place of delivery of that good is there where the dispatch or the sending of the good towards the customer begins. And here, second paragraph which I mentioned, paragraph 3, section 7, first sentence is the one which contains the basic rule. If the good which is delivered is not moved or dispatched during the transaction, then the place of delivery is where the good is situated or located at the time when economic ownership or control or power to dispose or position like an owner changes, however you translate it. Sentence 2 then deals with some special cases which are not of relevance for us at the moment and not relevant for beginners. Yeah, so let's have a look to a sample case. What does this mean? Mr. E from Essen in Germany meets a buyer for one of his goods at a notary's office in Cologne, Germany, and sells him a house which is located in Norway for a price of 300,000 euro. To test is number 1 USDG. 3.1 is a delivery of a good, and the answer is a house is a good, a tangible good. And selling is transfer of ownership, so the position like an owner is transferred. So we have a delivery under the rules of 3.1 USDG. Now, is it in the inland? They meet in a notary's office in Cologne, but that might be misleading. We have to apply the legal rules 3.7. The good is not moved during the delivery. Yeah? You don't buy a house and take it home. It stays where it is. So we have a case of delivery without movement of the good. 3.7 says the place of delivery, so the place where that delivery has to be subjected to tax law, that's meant. That is where the good is located at the moment when ownership changes. That is Norway. And Norway is not in the German inland, so German tax law does not apply, not taxable in Germany. Next case. Car trader in Aachen in Germany sells a car to a customer from Russia. The Russian customer comes to Aachen, knocks on the door of the trader, asks for the car, pays 20,000 euro in cash for the car and takes the car home to Moscow in Russia. Is the whole affair taxable? That's the question. The answer is, what do we have to test? Number one, USDG. Is it a delivery of a good under 3.1 USDG? And the answer is a car is a tangible good. Selling as transfer of ownership. So we have a delivery. So next question is, did that happen in the inland? And the answer is yes. 3.6 says the car is moved in connection with the sale because customer takes it away. It doesn't stay where it was sold. So that's where the movement towards the customer begins. So the good is here moved from Aachen to Moscow. Beginning is in Aachen. Aachen is in the inland, so this transaction is taxable. The next step would show that it is then tax exempt as an export if the car trader can prove that sufficiently. But nevertheless, first it is taxable, and if there is no proof of the export, it would be liable to tax. Okay. Number 3 does not exist, but let's think about services. You also had the rule that rendering a service, which is taxable in the inland, would be taxable. Again, number 1 is the basic rule, which has to be tested. The definition of a service is in 3 number 1 USDG. Anything that you do for somebody else that is not a delivery of a good. And if that happens in the inland, that is regulated by very special rules. That's a mass of them, nearly 20 different rules in paragraph 3A, 3B, and 3E of the USDG, or in a bigger chapter in the VAT directive to which these rules correspond. Here, again, you can throw a glance at the translation. The basic rule is 3.9 sentence 1 here. Services are those transactions which are not a delivery of a good. And then, as this is a bit abstract, they can consist in abstaining from an action or in tolerating an action or a situation. And naturally, they can also consist of doing something actively that's not even clearly said. Yeah. And sentence 3 regulates a very specific case, which is not of any interest for us at the moment. So, and this here is just to give you a short or more lengthy overview about what the rules for the place of a service are. There are two basic rules, 3A1 and 3A2. 3A1 applies if you have a private customer. 3A2 if your customer is an enterprise or has a status which is equivalent to an enterprise somewhere in the EU. So 3A1 says a service is rendered at the place where the entrepreneur, the business owner, has established his enterprise, unless the paragraphs 2 to 8 and the paragraphs 3B, 3E, and 3F has been eliminated last year, so my translation is not up to date there, do not provide something else. If the service is rendered by a fixed establishment, so if your business is run at different places, then that place counts, which was involved in the rendering of the service. Makes sense. So if you have a haircutter's shop and have 3 different shops in the city, then, or in different cities, then the place of supply is naturally the shop where the haircutting to the customer was done, plain and simple. 3A2 is place of supply of a service if the service is rendered to an entrepreneur for his enterprise. Then it is rendered at the place where the recipient, so the business customer, has established his enterprise. If not, provided the paragraphs 2 to 8 and paragraphs 3B, 3E, and again outdated Eliminated 3F, do not regulate the matter otherwise. And then details again follow. And then, by the way, 3A3 follows a lengthy rule, 3A4 lengthy, 3A7, 3A8, 3B, 2, 3C is then dealing with another thing. And just to show you again how much it is, that's sometimes a bit abbreviated, the translation already. So this gives you one basic message. If you have to determine the place of a service, you will have to look many things up, and you can't know that by heart. And imagine if after 10 years with dealing with the matter, you know it by heart, then you can be sure it will be changed in very short time, so that your knowledge which you learned by heart becomes superfluous and senseless and even dangerous. The only way which you can use to determine the place of supply of a service is always look it up, look it up, and look it up. Here you see it again in a slightly better version, I hope. Basic rules are: if customer is a private person, then the place of supply is where the supplier runs his business, has established the business. Or if the customer is an entrepreneur too, then the service is taxed at the place or is attributed to the place where that business customer has established his or her business. Some special rules deviate from these basic rules, and you always have to check the catalog in 3A paragraph 3 and the special rules contained in the paragraphs or subsections 4 to 8 USDG only need to be checked in most cases if the case has some connection with the third countries. So if supplier is from a third country, customers from a third country, the event takes place wholly or in part in a third country, then look into subparagraphs 4 to 8. If not, then not. The only exception where a case inside the EU with no connections to third countries also is involved in that part of the law is telecommunications, television, or internet performed services from a business owner to a private customer who resides inside the EU. That would be covered in 3A5. In all other cases, you can directly skip these passages because they can't become relevant. Let's again show you how such a case will work. A lorry driver transports goods from Cologne, Germany to Palermo, Italy. He has been ordered to do so by a forwarding agent who has established his business in Finland, which is in the EU. The lorry driver is an entrepreneur whose firm is located in Germany, not in Germany, but in Belgium. My question is that chaos here taxable in Germany or not? And the answer is, well, let's first think about what we have to test. We have to test number 1, and let's think who does what for whom. So who is supplier and who is customer? The lorry driver is the entrepreneur in the case, and the Finland forwarding agent is an entrepreneur, but here he is customer. To transport goods is not a delivery, because if you drive goods of other people just through the country from here to there, you can't transfer the position like an owner, because it's not your own stuff. It's the assets belonging to the person who gave you the order to ship that stuff from here to there. So you can't transfer ownership. So what you do is not a delivery. So driving things through the world is just rendering a service. Mere transportation is service. So we have a case of 3.9, service. So we need to determine the place of that service. 3A has to be tested. Basic rules are 3A1 for private customers or 3A2 for business customers. And we have here a business customer. So 3A2 is the relevant basic rule. So the service has to be taxed where the business customer has established his business, that is in Finland. We have then to check, we would have to check. We are not going to do this now. The other passages of 3A and of 3B, and if there is a deviating rule there, that's not the case, by the way. And so the service is rendered in Finland, and that is not in the German inland, so it's not taxable in Germany. Case 2. German business owner from Hamburg meets an American lawyer in Mexico. So again, a chaos. People from everywhere meet anywhere. The American lawyer there gives legal advice to the German with regard to some potential violations of patent rights which the German firm might have committed. The lawyer asked 10,000 euro for his services. Is it a taxable transaction? And the answer is, we test again number 1. Giving advice is a service because advice is not a tangible good. So 3 number 9. In the inland, 3A. Basic rule is here again the basic rule for services rendered to a business customer, 3A2. So where the customer has established his business, where these people in reality meet does not play any role. So a customer is the German business owner. He or she is in Hamburg, and so service is attributed to Hamburg. Hamburg is in the German inland, so the service is taxable in Germany. Case number 3. Lawyer from Munich gives advice to a wealthy Swiss customer in Zurich concerning that customer's testament. So last will. Charges him with 9,000 euro for that. I have no idea what you get charged for a testament. But let's assume it's worth 9,000 euro. The two meet several times to discuss the draft and the final version, to sign it. And so once they meet in Germany, twice in Switzerland. Yeah, now you see again that's a red herring that leads you up the garden path, as I heard that one can say it this way. So that's just to irritate, confuse, and lead you astray. Because where things happen does not really play a role. The place of supply has to do with the question, to which country has this event been attributed, which country is meant by the EU to be responsible for taxing that event and do the legal procedures. That is entirely dependent on the legal rules and not on common sense, at least not on your and mine common sense. So the ideas behind how they decided on the rules, these ideas will not be understood by beginners. So just concentrate on the idea. You just have to check the legal rules and apply them. So first, we have a service. Advice is no good. Advice is no good. I hope that the advice was good, but under the legal aspect of the VAT law, the advice is always no good. Yeah, so, but not bad. And 3A1 is applicable here because your testament is always a private matter, I suppose. And so even if you were an entrepreneur, you show there up in your function as a private person. So the service is rendered to a private person. And then the rule is the service is taxable where the supplier has established his business. That is in Munich. So making one's testament is always a private thing. So place of service would be Munich. Inland would be fulfilled, so it would be taxable. Now, that is only according to the basic rule. And now we might be very, very well qualified, and then we would even look deeper into the matter And then we would have to check the other paragraphs, 3.4 to 3.8, because there is a connection, ladies and gentlemen, to a third country. So, as you see here, 3A4, let's begin with that. Is the recipient of a service, so our Swiss customer, named in sentence 2? So, the rule does not apply to all services, but only to the kind of services which are named in sentence 2. That's going to come, that's a whole list. Neither an entrepreneur for whose enterprise the service is rendered, nor a non-entrepreneurial juridical person to whom a VAT identification number has been issued. So let's clarify this or make it more simple. If the recipient of a service is a private person, and if that private person has his residence or seat in a third territory, yes, Switzerland, then the service is deemed to be rendered as his residence or seat. So then the place of supply would be where our customer lives. That would be at Zurich. But condition is that the service which is rendered is named in sentence 2. So let's read sentence 2. Service in the sense of sentence 1 are transfers and assignments of copyrights, patents, licenses, trademarks, and similar rights, advertising services, the services as lawyer, patent right lawyer, tax advisor, tax representative, auditor, expert, engineer, member of a supervisory board, translator and interpreter, and similar services, especially juridical, technical, and economical consulting. Here we are, services as a lawyer rendered to a private person. Oh, we should be sorry. That is what we didn't see in the first version, and so we have to correct what we have written just a moment ago, and we come to a different result. So you see, you always have to read the whole thing, and we will have to correct this and end up probably with a different result than just before. So let's check. We did it, and we found out the place of supply of that service is Zurich, because customer is not an entrepreneur but a private person here. Legal services are deemed to have their place at the place where that customer is. 3.4, number 3, that was, and that's Switzerland, and so this is not in the inland, so not taxable in Germany. Yeah, surprise. Okay, let's look to a fourth case. A German notary from Munich certifies a contract between two persons. The one is from Cologne and is a seller, and the other person is from Dortmund and is a buyer concerning the purchase of a building which is located in Dresden. Dresden is also in Germany, in Saxony. Yeah, hope so at least. Last time it was. Is the activity of the notary taxable? And the answer is, solution is again, let's test our number 1. The service is, yeah, it is a service, 3.9. Certifying a contract that's not a tangible good. The paper does not really count. The important thing is the service, the attestation that everything is correct. And so the place of service is here neither 3A nor 3.2, because 3A3 number 1 has a special rule that services which are closely connected to real estate property are taxable where that real estate property is located. So in plain words, if you have a piece of land or a building and the service has to do with that piece of land or building, then the service is always taxable where the piece of land or the building is. So that would be here in Dresden. By the way, if you have to deal with a case, any task, on where a place of supply of a good or of a service is ever important, you always have to name the place as exact as you can. So it would not be sufficient to answer in the inland here, because then people would find out you did not know the exact place, you just guessed. All the three cities here named are in the inland, so it will be in the inland. That is a trick or a try to escape application of your knowledge, which nobody will tolerate. So examiners will always demand an answer to the point. So Dresden, and so that's in the inland. See 1, 2, sentence 1. So it's tax. Good. A last short additional remark: you should notice that if you take a good out of your own firm for private consume, officially that's not a delivery, because you don't transfer ownership. You were the owner before and you are the owner afterwards. Nevertheless, that will also be taxable, because otherwise a business owner would have the chance to untaxed consume. So withdrawing a good or a service from one's own enterprise is treated as a fictitious delivery or a fictitious service rendered to yourself. The legal sources references are here. Okay. Rather rarely is relevant the next 11 number, that's 11 number 4, the importation of goods in the inland. Importation is a term which is only reserved for goods which come into the inland from a third country, so not from the customs territory of the European Union, not from a member state of the EU. So you cannot speak of importation if something comes from France to Germany. So in the inland, that is the place where the customs duties for that importation have to be fulfilled. That's usually at the border, but you can agree with the customs authorities that these procedures are delayed and happen at another place in the EU territory under the supervision of the customs authorities. That is why they formulated that in a way that they speak of the importation in the inland and not into the inland, because it might be that your good is already at Hamburg and there at the customs authorities office in Hamburg. There you open the lorry or the truck and just allow then you pay the customs duties, and then the goods are allowed to circulate freely, so that the importation was delayed until Hamburg, although you perhaps crossed the border at the Swiss-German border 2 days before. So, the details do not interest us usually, because we usually don't cross the border with goods. By the way, one thing you must remember: the 11 number 4 rule is also applicable to private persons coming from a third country and carrying goods in their baggage or so into the inland. So that personally affects you when you land at the airport and come from a third territory. Then you have to go to the customs check. 11 number 5 is a kind of a parallel to the importation rules. It has to do with goods which come from the EU into the inland. The peculiarity is that between the EU countries, the border checks have been completely removed. So the 11 number 4 importation rule, which relies on the check at the border by the customs authorities, cannot work there. So one looked for a kind of an adequate replacement and said, when goods come from the rest of the EU towards the inland, then at least certain customers can be expected to report that transfer of the good into the inland to the fiscal authorities and declare the tax due on that good on their own. And that can only be expected from entrepreneurs or certain other institutions which are so well trained that they have a bookkeeping and that one can expect that they can understand the rules. That is never expected from private persons. So if you are a business owner and carry a good for your business from France to Germany, you have to report the value, the market value of the good when it crosses the border into Germany to the fiscal authorities in your VAT tax declaration. As an inter-community acquisition of goods, if you are a private person, that's it, because a tax claim directed to private persons here would never work. You have no border control, you have no bookkeeping, you have no way to check if people would report the truth, and if a tax claim is absolutely unenforceable, then you should never raise such a tax claim, because that would only be awkward and should be avoided. Naturally, also with the intra-community acquisition of goods, you need to determine a place where it is taxable, and that is done in 3D USDG. That is done at the place where the good is at the end of the transport. Now, tax exemptions is the next step in the testing scheme. Some are declared as tax-free, and there are some basic rules. The most important is what is taxable but not explicitly exempted is automatically liable to tax. By the way, what I did not mention is if something is not taxable at all, then it cannot be freed from tax. That's as simple as you can't be released from prison if you are not in prison. So you can't be pardoned for a crime if you didn't commit a crime or so. So what is not taxable can never be freed from the tax, can never be exempted. So the first step when you think of an exemption is always and must always be if the matter is taxable at all. If not, forget about any further step. No tax exemption possible. So, yeah. Then tax exemptions are to be interpreted in a narrow and strict sense. What is not explicitly exempted is not exempted, even if it is similar to a tax-exempted transaction. So you need to read exemptions carefully, and naturally, if you work with a translated text, no translation is exact. So you would have to find out if your understanding is really correct, or if by the translation you got a wrong impression. Then the awkward principle, which I already named a few minutes before. If an output transaction is tax-free, then usually the input taxes are lost, which you paid for the goods and services which you needed to produce that output. So tax exemptions have positive and negative consequences. Sometimes people want to avoid a tax exemption for that reason, and it might be that you get granted an option to opt out of a tax exemption and into tax liability. Some examples for tax-free things would be selling real estate, land, buildings. There you can really opt for tax liability. Insurance contracts for number 10, there you can't opt for liability. The services of insurance agents for number 11, no option. Letting real estate property for rent for number 12, there you can opt. Medical treatment for number 14, no option possible. Medical treatment is always tax-free. Delivery of human blood and human organs, that's rather strange. I always call this the vampire exception, but I just put it on the list for reasons of to show you some more strange and extraordinary exemptions. So sometimes things are relatively far-fetched or far away from our everyday life. Nevertheless, this is all these strange things usually have good reasons. For example, delivery of human blood is tax-free. Imagine when you donate blood for the Red Cross, then they always pay you a small amount for it, and that would be a regular activity. It could turn you into an entrepreneur or so, and somebody might come to the idea they charge you VAT on the money which you get from the Red Cross or so. And that would probably ruin the whole donation campaign. And 30 euro is, for example, if somebody donates blood and that person is a highly paid lawyer, that's already no amount which really matters. And then if there would also be tax consequences combined with that, then people would stay at home and don't donate blood. And so that even very strange things usually have very good reasons. It does not play a role that we don't understand them before we think ourselves deeply into the matter. We usually don't need to. But whenever you get propaganda that certain rules are absolutely senseless, or that EU rules are absolutely strange and senseless, don't forget that. There is in Germany also an exemption for number 19 for blind people who do not employ more than 2 employees. That's a very old exemption which was introduced into the German USDG, I believe, shortly after World War I, and it has never been eliminated. The EU allowed us to carry that exemption on. I believe it does not exist in other member states. But if you are wearing glasses and they become bigger and bigger and bigger, so then for number 19 might give you hope. When you don't see anything at last, then at least you can hope for a tax exemption. Will not help you, by the way. Teaching activities, if they are done by independent persons, could also be tax-free, and so on and so on. In all these cases, these exemptions on the list here kill your input tax deduction. So you don't have to pay, but you don't get input tax refund. Other exemptions refer to exports. These are economically the most important ones for most countries because export activities are of high importance. And depending on the proofs which are demanded, the exemptions are different. For example, the exportation of goods into third countries is regulated in Section 6 USDG and is declared as tax-free in 4 number 1 letter A. You see, it's the first position on the list of all exemptions because it's the one with the highest importance. And if you send something to other states of the EU, it will then be tax-free under certain circumstances as an intra-community delivery of goods, regulated in the German text of 6a USDG. And these conditions can be explained plain and simple. It will be tax-free as an intra-community delivery of goods if on the other side of the border, the recipient, whoever it gets, your contract partner, will have to declare it as intra-community acquisition of goods. So that even if we have no border checks, the system here is you get only a tax exemption here when it's secured that in the books of your customer, the goods will show up again. So the main condition or the main thing which you should remember is within the EU, as private persons can cross the border without declaring what they bring into the other EU state. Within the EU, you only get a tax exemption for an intra-community delivery if, in most cases at least, your customer is an entrepreneur. Whereas if you export things to Switzerland, to Russia, or also somewhere else, everybody can take a good and cross the border with it and declare it at the customs office for exportation, and then will get a certificate that the goods have been exported. So also private persons as customers can perform an export to third countries. Yeah, tax base is always the net amount. So if you get the gross amount in a case, then you have to calculate backwards. The gross amount is 119% of the net amount if the VAT rate is 90%. If you have 7% reduced rate, then the gross amount corresponds to 107% of the net amount. So you have to divide accordingly and calculate the net amount. The legal rule which applies that to that or which regulates that is just 10(1) USDG. The tax base is the net consideration or the net amount which is received, that is all what the entrepreneur receives in return for the delivery service, which means that's the gross amount, minus the VAT amount included in that gross amount, and that directly leads us to the net amount. In cases where no consideration is paid, for example, in case of a withdrawal, you take refuge to another supplementary tax base, that's 10(4), which says we take a kind of a market value or so, but only if no price is paid. 12(1), 12(2) give the tax rates. 19 is a standard rate, and it applies to everything where we don't have a special rule. A special rule you have, for example, for meals, any kind of meals, so food, potatoes, sugar, chocolate, and for some things which you can drink, but only in the very poor people's version and primitive, most primitive version, so coffee in form of powder or beans, but not prepared for consume already, so not made hot, or not in form of a fluid. Tea in form of leaves, or at least dry, not yet made hot, not in cups, also as a fluid. Milk, the other primitive form, is indeed the fluid, so milk dried would probably not, so milk powder is no milk anymore. That's rather the extraordinary version. Usual common milk is 7%. Selling books, something with culture, ladies and gentlemen, is 7%. Overnight stays in a hotel is under German law 7%, but the breakfast is taxed at 19%. Also here, the rule is what is not explicitly named for a reduced tax is covered by the basic rule. So when you go and buy a hamburger, that's 7%, because that is classified somewhere, or can be classified under one of the numbers in the catalog of 7% items. But when you go to a restaurant and sit down there and enjoy the atmosphere and so and eat a hamburger there, then it would be 19%, because sitting down at a restaurant is no more a mere delivery of a hamburger to you, but it's a service activity. They allow you to spend a nice hour or two in their nice restaurant, enjoy the service by the waiters and a good special event. So there you pay for something which only resembles or has a bit to do with the hamburger, but is no longer the mere delivery of hamburger, but something else. And if it is something else, it is no longer on the list of the 7% items. The formal aspect, so the paid stage of events, that's payer, arisal, invoice, declaration duties. Taxpayer is usually the entrepreneur, in rare cases the customer. See then paragraph 13b. The tax arises when usually at the end of the preliminary declaration period during which the transaction was made, section or paragraph 13. The invoice, the contents there is absolutely regulated. There you would get the information in paragraphs 14 and 14a USDG, a long list of things which an invoice must fulfill, and declaration duties, okay, that's rather specific, let's forget that. In the end, we can think a bit about cases, and for example, one case would be this here. Shop owner in Germany sells a bar of chocolate to a young customer from his own city, and the customer then pays an amount of €1 for it, so relatively easy and primitive case. And the only thing which is not absolutely primitive is the question. The question says solution of that case, naturally under German VAT law, and that is what we have to try next. So Let's begin. First, taxability. To test is 1 number 1 USDG, and we have to check first if that is a delivery, and the answer is yes. 3.1 USDG says chocolate is a good and a tangible good, and selling is a transfer of ownership or of economic ownership, so the position like an owner. In the inland, place of delivery, it is a delivery connected with the movement of the good, dispatch, transport of the good towards the customer. So 3.6 sentence 1 USDG applies. Place is where the movement or transport of the good towards the customer begins. That is here Rewe in Germany. That means the conditions of number 1 are fulfilled if we can assume, and we assume that here now, that the shop owner is an entrepreneur, that he acts within the range of his enterprise, so that it's an entrepreneurial activity of his, not a private one, and that he gets a consideration paid. That's also clear because he gets €1 in return. So the transaction is taxable in Germany. The tax exemption. And now you probably know from your own everyday life experience that chocolate is usually not tax-free. There might be exemptions which could be imaginable. For example, the shop owner could be blind and it would be tax-free. Or it might be that it is like a kind of a cafeteria for students. They are, with most of their transactions, tax-free under a special rule. But here, no exemption in paragraph 4 USDG can be seen, so at least not proven. So the whole affair is, well, liable to tax. Sorry. No. Oh, a bit of a problem. Yeah, liable to tax. Number 3, the tax base. Paragraph 10.1 says everything which the business owner gets, that's €1, minus the VAT amount included therein, is the net amount, and that is the tax base. Now we leave that open for a while and have a look, because we need to calculate the VAT first, the tax rate, according to 12.2. I don't know by the number by heart now. Number should be filled in here. USDG. I believe it's 12 number 30 or 31. Don't know for sure. Chocolate has a rate of 7%. So that means for us that here 7 out of 107 of €1 is indeed that what we need. So the best opportunity, the best way is probably to take a calculator, and the calculator says us that's 93, no, yeah, €0.93. 45, okay, they are rounded down. The tax rate is 7%. So the tax is 7% on exactly, that would be 0. Oh my God. That would be 6.5%. 6.5 cents. And that is probably okay. The taxpayer, etc. So the formal aspects, taxpayer is the entrepreneur. So A, that is somewhere to be found in 13A, number 1 USDG. Look it up at home if you have the tax files. If not, just believe it. Arisal of the tax. At the end of the preliminary declaration period, that the month during which the sale, the delivery is better, the delivery was made. That basic rule is to be found in 13.1 number 1 USDG. Invoice, not necessary if customer is private person, because for private consumers you cannot recover input tax, so not relevant. Declaration duties, nothing special. Sometimes there are some peculiarities, strange things combined with these cases, which we did not foresee when we designed the testing scheme. None. 7. Input tax claims. Naturally, seller A can claim keep the input tax from the price which he paid for his own acquisition of the chocolate, but that was possible already time ago when chocolate was bought. Okay, simple, solved. Now, case 2. A factory owner from Munich, Germany gets an order for a production machine from a customer in Moscow in Russia, and the customer comes to Germany and brings the machine to Russia himself. The price paid for the machine is €200,000. How is that case to be treated under VAT law? That's a question, ladies and gentlemen, and we should deal with that immediately. Okay, so let's try. First, again, taxability comes into play, and we have to test number 1, because naturally this is neither an importation nor an intercommunity acquisition. This is just a simple sale. So delivery of a production machine. Yes, this is a delivery, section 3.1 USDG. The machine is a tangible good, and selling is transfer of ownership position. So we have a delivery. That's clear and undeniable. Now, place of delivery. Is it 3.6 or is it 3.7? So will that be moved or not? And the answer is here. The customer comes and moves the good outside Germany. So Yeah, with movement place where the movement or transport of the good towards the customer begins. Here, Munich, that is inland under section or paragraph 1 to sentence 1. Here we end up with a very easy conclusion, because the conclusion is taxable. Tax exemption to test is paragraph 4 USDG, especially for number 1. Letter A, is it an exportation? And the answer is the good is transported into a third country by the customer, and the customer is a foreign customer. So it is an export under a rule which we have not yet become familiar with, 6.1 number 2 USDG plus 6.2 USDG. So you could look up everything which you need to apply a law. That's always good. If you have a robust text of the law, everything has been foreseen and regulated. And so if an expert is given, so it's tax-free under 4 number 1 letter A. Case finished. So now still one last third case for today, a small one, and then you probably will really be happy when it's over this time. Yeah, Mr. Trickser, a car trader from Trier in Germany, offers a car to a customer who is interested in buying it. Official price is 30,000. You will get a special discount of 40%. Sorry. Customer accepts, takes the car and pays naturally and drives away with it. So what's the solution of this case? That is a good idea, and we should try to come to deal with it as far as we come. Let's try. Probably that's boring, but the first question is it taxable? And so we have to test number 1. Is this a delivery? And the answer is yes. 3.1. We have car is a good and selling is transfer of ownership. So clear case. Place of delivery. Well, customer takes the car home, so it is moved. So where the movement of the car towards the customer begins, that is Trier. So that's in the inland under 1 to sentence 1. By the way, all these things which I cite here and which you do not yet know, look them up in the TaxX slides, just to get a small impression about what it really is, what you are talking about here with me. So it's taxable. That's a clear case, naturally. And now, ladies and gentlemen, where do we have to? What do we have to do now? Next step, tax. Sorry. Tax exemption. And we have no exemption can be seen under 4 USDG, so liable to tax. Number 3, tax base. 10.1 sentence 1 and 2 USDG is all what the car trader gets. That is the gross amount. And all what the car trader gets is 30,000 minus 40% of 30,000. So it's 18,000 only. That's the gross amount, because the legal formula does not talk about what official price is made, what should be paid or so, but all what he really gets. And that's only 18. 19% is a car. We can probably guess that already. That is probably 2,895 or so. So net amount is 100 divided by 119 times 18,000. And that will be 15,126.05. And if you add that up, it should match again and become 18,000 again. Tax rate and tax, well, 12.1, 19% here, 90% on 15,126. So that we have that already calculated immediately before. Formal aspects. Taxpayer is the trader. So Mr. Trickster, that was again in 13A1 number 1 USDG, arisal of the tax at the end of the preliminary declaration period during which the delivery took place. Here no dates are given, so we can't specify that. Invoice details. Normal details, nothing else. 14 USDG. Declaration duties, nothing special. Any particularly special aspects, no. And input tax claims of Mr. Trickster, yes, for the input tax which he paid for this car to the wholesaler or factory. By the way, if you want to check that 15.1 number 1, that was already deductible already at the time of the purchase of that car by him. That is then the end. We have wrote down everything which we can imagine to have to do with that case. So you see, just okay. Took us 6 minutes, nothing more. So that's enough for today, and I don't know how do you feel, but I really and genuinely feel a bit exhausted, and I hope I can enjoy the rest of the evening now in front of a television set, and hope you can do that too. See you again next time, and I hope that video of today was a bit helpful and not only a torture. Usually I would like to say that I hope you enjoyed the video, but this video is more than 2 hours. One can reasonably not expect from every living human being that you really enjoyed that, but it would be sufficient if it did not perfectly kill you off. Thanks and have a good time. Till next time. Goodbye.